All right, good morning, everyone. We're multitasking here today, and I'd ask your indulgence as we're already beginning late. The ranking member is on his way, but I'm going to go ahead and get started because we are going to have to recess for a quick PQ and rule vote on the floor, and we're going to try and keep things going as fast as we can. So I appreciate all of your indulgence, both members and our witnesses. So the Subcommittee on Capital Markets will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled, Examining the SEC's Agenda, Unintended Consequences for U.S. Capital Markets and Investors. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 5 minutes to give an opening statement. I want to thank you for joining us today to examine the rulemaking process of the U.S. Securities and Exchange Commission, the SEC, an institution central to upholding the integrity, transparency, and stability of our nation's capital markets. The United States boasts the world's deepest and most liquid capital markets, serving as a cornerstone of our economic growth and prosperity. These markets are already among the most heavily regulated sectors in our economy. This underscores the need for our regulators to exercise the utmost diligence in their rulemaking activities. Interventions must narrowly address known market deficiencies without inadvertently causing harm or disruption, especially in times of economic stress and uncertainty. Regulators should not use their position to experiment with academic pet projects. Transformative changes must be meticulously crafted and thoroughly vetted to account for indirect costs and cumulative effects, and only undertaken when explicitly authorized by Congress. Regrettably, we have observed a departure from this approach under the current leadership of the SEC, led by Chair Gensler. In recent months, our subcommittee has undertaken a rigorous examination of the SEC's actions. We've heard testimony from various SEC division directors, including those overseeing investment management, corporation finance, trading and markets, and economic and risk analysis. In these dialogues, we've raised serious bipartisan concerns regarding both the content and process of the Commission's rulemakings. Today, I'd like to draw attention to the most concerning aspects of the SEC's present approach to rulemaking. First, the SEC has embarked on an extraordinary pace of rulemaking since the spring of 2021, a pace that raises questions about the agency's ability to comprehensively evaluate the cumulative effects, indirect costs, and cross-market implications of these rules. Chair Gensler's rush to implement his unprecedented rulemaking agenda is jeopardizing the health of our capital markets and hard-earned dollars that millions of Americans have invested in them. Second, the SEC has significantly curtailed public comment periods for proposed rules, at times even overlapping them with major holidays. This inhibits affected investors and market participants from providing thorough feedback, and shortened comment periods deprive the SEC of the information they need to craft better, more surgical proposals. I would going to enter into the record a record of nearly 20 rulemaking and proposals that have undergone less than 30-day comment periods, for the record, so it's clear that this is happening. Extending these comment periods is imperative to allow market participants ample time to assess and evaluate the potential implications of these rules. Third, the SEC's apparent disregard for congressional concern and congressional inquiries undermines trust in the regulatory process and raises accountability questions. This is evident in bipartisan opposition to the SEC's approach to a number of issues, including MiFID II, equity market structure, swing pricing, and conflicts of interest. One of the most recent examples of this blatant disregard for congressional inquiries is in response to a letter that I sent in September along with Mr. Hill and 19 other representatives and senators regarding the predictive data and analytics proposal. It's been more than 30 days since we sent that letter, which posed specific questions to the SEC, questions that need timely responses. We received emails assuring us that the SEC would be following up with a response, but more than 30 days have passed and still nothing. Finally, the hearings leading up to today made it clear the SEC is exceeding its mandate, particularly in areas related to environmental and social policies. It is our duty to ensure agencies adhere to their statutory authority and do not create far-reaching policies that Congress never intended. Today, we have the opportunity to explore these concerns while shedding light on the potential consequences of the SEC's agenda and current approach to rulemaking. I look forward to hearing from our esteemed panel of experts as we delve deeper into these matters in order to promote sound financial regulation and safeguard our capital markets. Welcome.
Yes.
Just in the nick of time. Are you ready to proceed, sir?
I am indeed.
Thank you. The chair now recognizes the ranking member of the Subcommittee on Capital Markets, a gentleman from California, Mr. Sherman, is recognized for
4 minutes.
4 minutes for an opening statement.
First, I apologize for being late here. We had a critical meeting on the Israel supplemental, and that's an issue I'm very involved in. As to the issues before us, the most important issue affecting the SEC is the possible shutdown of government in 15 days. That means no IPOs. That means that our $100 trillion capital markets are without any police force. What could go wrong? And it means that many established companies seeking an additional stock issuance or a bond issuance will not be able to make it. So shutting down the government means shutting down a big chunk of our capital markets. I think that it's important to focus on some of the things that the SEC is doing right, starting with crypto. Some $130 million of cryptocurrency has gone to Hamas and Palestinian Islamic Jihad, and the SEC is the one agency here in Washington that is most effective in clamping down on crypto, which is designed to be a perfect means for hidden money, hence the term cryptocurrency, getting to the worst actors in the world. As to ESG, it is now obvious that a material number of investors find it material to their investment decisions. That's why there are literally dozens and dozens of mutual funds and corporations and investment vehicles that design themselves for those investors that care about the environment in their investing. I do think that Scope 3 is a problem because as an accountant, I just don't know how you can possibly get there. Our accounting system captures what's on the balance sheet. 50 years ago, 90 years ago, I believe, 90% of the value of the company was there on the balance sheet. Now 90% isn't. That is to say the cap value of the company is not explained by the balance sheet except to the extent of 10%. That's why we need to start reporting better research, which should be capitalized, workforce metrics, and other metrics that help determine the real value of the company. Swing pricing is a mistake. It is unfair to the middle class because the wealthy can put together their own portfolios and they don't need mutual funds. Institutions can be on CITs. And of course, the West Coast is disadvantaged to the tune of 3 hours. Without objection, hopefully without objection, I'd like to put in the record my letter to the administration identifying how it's also a junk fee. And those focused on what President Biden is saying is stop preventing us from having junk fees is critical. I'm concerned about some of the SEC proposals, but in general, they're doing a good job. In particular, the conflict of interest proposal is well-intentioned if it's properly limited. You shouldn't be able to design a unique investment and then bet against it. On the other hand, it's very important that every major player in the market be able to invest on the long side or on the short side in widely traded indexes and hedges and prices that they did not invent, they do not control. So I look forward to hearing from our witnesses, and I yield back.
Gentleman yields back. Today we welcome the testimony of Mr. Ken Bentsen, Jr. Mr. Bentsen is the president and CEO of SIFMA. Ms. Dalia Blass. Ms. Blass is the senior investment management partner at Sullivan and Cromwell LLP. Mr. S.P. Kothari. Professor Kothari is the Gordon Y. Billard Professor of Accounting and Finance at the Massachusetts Institute of Technology. Mr. Tom Quaadman. Mr. Quaadman is the Executive Vice President of the Center for Capital Markets Competitiveness at the U.S. Chamber of Commerce. And Ms. Amy Borrus. Ms. Borrus is the Executive Director of the Council of Institutional Investors. We want to thank you all for taking your time to be here. And without objection, your written statement will be made part of the record. Mr. Bentsen, we're going to try and get through as much of this as possible. So, Mr. Bentsen, you are now recognized for 5 minutes to give your oral remarks.
Thank you, Chairman Wagner, Ranking Member Sherman, and distinguished members of the subcommittee. Thank you for the opportunity to testify today. As you said, the U.S. securities markets are the deepest, most liquid in the world. They're also the envy of the world. They are among the most regulated sectors of our economy. And unique to the United States, 75% of commercial activity is financed through our markets. Our markets allow for investors to put their savings to work, spurring job creation and economic growth. Therefore, it's critical that regulators tailor policies to address legitimate market failures without unnecessarily harming or disrupting markets, especially when our economy faces serious headwinds. However, the high volume and speed of regulatory change proposed by the Securities and Exchange Commission could result in negative consequences for the real economy. Throughout the last 2 years, stakeholders, academics, and members of Congress on both sides of the aisle have expressed concerns with the volume and pace of new rule proposals from the SEC. The data demonstrates that these concerns are well-founded.
Mr. Bentsen, could you please pull the microphone a little closer? And that would apply to everybody. Thank you.
Right. In addition to the concerns regarding the unprecedented volume, commenters, including SIFMA, have expressed concern that truncated timelines for multiple overlapping rule proposals limit stakeholders' ability to analyze collective impact of the proposals. Failure to do so can result in conflicting and poorly drafted rules with potential negative impact on capital markets and, importantly, investors and issuers. There may be justification for certain rules, such as the transition of the securities settlement cycle from 2 days to 1, which SIFMA and the industry strongly support, or those mandated by the Dodd-Frank Act. We remain concerned, however, that the SEC has not sufficiently prioritized its agenda and in several cases is acting without clear evidence of market failure or direction from Congress. Lack of prioritization in pursuit of novel proposals has crowded out other important mandates, such as the pending data security rule for the Consolidated Audit Trail, the largest securities transaction database ever created, which collects trade data and customer personally identifiable information on every stock and option transaction. That rule was proposed 3 years ago and still has not been finalized. In addition, there is much more to implementing market rules than simply promulgating new regulatory text. In most cases, the industry must develop programs and processes, often with significant technology builds, as well as policies and procedures to comply with the new rules. The industry will face an unprecedented implementation situation. Rushing to implement dozens of complex, far-reaching new regulations simultaneously, absent prioritization, coordination, and robust cost-benefit analysis is not conducive to effective and enduring policymaking. Perhaps most controversial and least considered are the SEC's equity market structure proposals. These proposals would dramatically overhaul the U.S. equity market structure and potentially undermine the recent expansion of market access that investors enjoy today. Going back to the late 1990s, Congress, and in particular this committee, studied and proposed various changes to our equity market structure. In response, multiple commissions undertook a methodical and deliberate approach to developing proposals and receiving public comment that culminated in Regulation National Market Structure, or Reg NMS, in 2005. In developing Reg NMS, the Commission sought and received significant public and stakeholder feedback over a period of years before proceeding, including multiple public hearings, concept releases, and rule proposals to receive the input from stakeholders. There has not been the same deliberative process with these substantial proposals. The proposals also lack clear direction from Congress. As recently as 2021, this committee held 3 hearings in response to the GameStop meme stock phenomenon. The committee issued a detailed report proposing several policy recommendations for the SEC, FINRA, and DTCC to undertake. None of the Commission's proposals are among those congressional recommendations. There's also almost no analysis on how the proposals relate to or would operate with each other and the anticipated cumulative effects on markets and intermediaries and investors if more than one proposal were adopted. And I would note that is contrary to the guidance put out in 2011 by the Obama administration's Office of Management and Budget as part of the OMB's work to expand cost-benefit analysis, said that agencies should consider the cumulative impact of multiple proposals going out. And that builds on the Clinton administration's guidance with respect to cost-benefit analysis administration, which built on the Reagan administration's guidance from the OMB. Stakeholders from all corners of the markets have voiced oppositions to these proposals. The one exception is the proposal to update Rule 605, which has not been substantively updated since its adoption in 2000. SIFMA supports this proposed update and believes it is a natural starting point for the path forward. While we support some of the Commission's proposals, we believe others fail to identify a market failure and lack clear direction from Congress. The agenda also lacks prioritization and sufficient cost-benefit analysis, particularly the cumulative impact, as I mentioned. Just as the Commission has a duty to ensure fair, orderly, and efficient markets, rushing to do too much too quickly could result in poor policy outcomes and overwhelm market infrastructure. Thank you.
I thank you, Mr. Bentsen. Ms. Blass, you are now recognized for 5 minutes to give your oral remarks.
Thank you, Chairman Wagner, Ranking Member Sherman, and distinguished members of the subcommittee. I appreciate the opportunity to testify today. I am testifying in my personal capacity and not on behalf of Sullivan and Cromwell or any of its clients. Before joining the firm, I was the global head of external affairs at BlackRock. Prior to that, I had the honor of serving at the SEC for more than 14 years, culminating my tenure as the director of the Division of Investment Management. Based on my experience at the SEC in industry and in private practice, I am concerned by the pace and scope of the SEC's rulemaking agenda. I strongly support well-reasoned rulemaking. My support for such rulemaking is clear from my record as division director, where I recommended several major rules to the Commission that improved investor protection and the resilience and efficiency of our markets, including derivatives, fund valuation, and advisor marketing. I also led the interdivisional teams that resulted in a recommendation for the standards of conduct for financial professionals. During my tenure at the Commission, I came to appreciate the important role of funds in our economy and the lives of Main Street investors, including retirement savers. Regulated funds provide professional management at a reasonable cost and with exposure to assets and strategies that investors could not obtain on their own. Simply put, they have democratized investments for Main Street investors. Private funds are integral to portfolios of well-managed pension plans and endowments and have been key to the continued economic growth of our economy, driving job creation and innovation. This is why I'm concerned with the breadth and scope of the SEC's rulemaking agenda, which is not in response to a legislative mandate, extraordinary market dislocations, or regulatory failures. The SEC has issued an unprecedented number of rule proposals. To date, there are 52. Assessed on an individual or aggregate level, they have the potential to fundamentally alter the capital markets, how investors interface with the markets, and the availability of products to meet their financial goals. The proposals have been issued at a rapid-fire pace, with inadequate comment periods and without adequate analysis or explanation by the Commission of why they are necessary and their costs and impacts. As further explained in my written testimony, many of the proposed rules have substantive and procedural flaws. Some fail to show an accurate understanding of the markets, the role of intermediaries, or the participants they seek to regulate. Others rely on speculative statements rather than rigorous substantive analyses backed by factual and empirical evidence. And generally throughout, there is no analysis of the interconnections and interdependencies that we're now starting to see with dozens and dozens of rules in our hindsight. To address at least some of these deficiencies, the SEC should publish a thorough analysis of the cumulative effect of its interconnected proposals, reopen comment periods thereafter to provide stakeholders with an opportunity to understand and assess these interconnections holistically, and only with the benefit of these efforts, Finalize the rules holistically, not in an isolated series, with phased multi-year implementation schedules that take into account the interconnections and the costs of complying with these rules. Not only does this process help protect investors and maintain the vibrancy and competitiveness of the deepest and most liquid capital markets in the world, but it also ensures the durability of the Commission's rules and the Commission's authority. The SEC has already been sued over major rules that have been finalized. Just yesterday, it was handed down a couple of decisions that were not favorable. If the SEC continues hurtling towards a finish line of its own making, it will harm investors in the vibrancy of our capital markets, which rely on regulatory clarity and predictability. It will also potentially harm its own ability to fully and fairly regulate the capital markets, as its authority is challenged and tested in courts. The SEC is fortunate to have an incredibly talented and dedicated staff. Economists, lawyers, analysts, you name it. It's got a tremendous bench of staff career staff in the agency, with time to do their job and an agenda that is grounded in the SEC's three-part mission of protecting investors and promoting capital formation and market integrity. These talented officials have and will deliver on behalf of Main Street investors. Thank you again for the opportunity to be here today to share my views, and I look forward to answering your questions.
We thank you, Ms. Blass. Professor Kothari, you are now recognized for 5 minutes to give your oral remarks.
Thank you. Chairman Wagner, Ranking Member Sherman, and members of the subcommittee, thank you for inviting me to appear before you today. I have been on the faculty of MIT, Sloan School of Management since 1999. I currently hold the Gordon Y. Billard Professorship of Accounting and Finance. From March 2019 to January 2021, I had the honor of serving as Chief Economist and Director of the Division of Economic and Risk Analysis at the U.S. SEC. In that role, I led a team of 160 economists and data scientists. Given my expertise and background, over the past few years, I have submitted several comments to the SEC, noting deficiencies in the comprehensiveness and quality of Commission's cost-benefit analysis. The deficiencies pose risks that costs of such rules will exceed the benefits, harming the competitiveness and efficiency of U.S. capital markets and the U.S. economy. I will use my comments to illustrate examples of recent deficiencies in economic analysis. To begin, private funds regulation. In February 2022, the Commission proposed new rules affecting the reporting and management of private fund industry that manages an estimated $18 trillion of gross assets. This industry is highly competitive and open to sophisticated investors, including institutions and accredited investors. In its proposed rulemaking, the Commission did not consider the full economic context and consequently failed to consider the full set of costs and benefits of the contracts between fund managers and investors that are negotiated by sophisticated parties and significant choices in investment funds, which ensures that fund managers compete on cost, performance, and reputation. Second example, best execution and order competition rules. In December 2022, the Commission proposed rules related to best execution regulations for broker-dealers, which would require detailed written policies and procedures for all broker-dealers, imposing additional requirements and conflicted transactions with retail customers. To support their rule, the Commission relied on an economic analysis on the relationship between payment for order flow, PFOF, and the prices received by retail investors, execution quality. The Commission used a regression analysis of 12 to 14 million observations that were intended to control for differences in stocks traded by customers of PFOF brokers and non-PFOF brokers. The economic analysis, however, was fundamentally flawed. It was biased and overstated in statistical significance. Moreover, putting aside the flaws in the regression analysis, the Commission did not consider how even its flawed analysis implied an economically minuscule effect of PFOF on execution quality, indicating that PFOF rates were, at best, a second-order determinant of execution quality. Turning to climate climate-related disclosures. In March 2022, the Commission proposed rules requiring climate-related disclosures. There are fundamental problems with the proposed rule. To begin, the rule subverted the existing standard-setting process in which FASB set accounting disclosures, albeit under the SEC's oversight and authority. The Commission failed to provide an adequate cost-benefit analysis of its proposal. Although the Commission estimated compliance costs, which are most likely underestimated, it did not attempt to quantify the benefits of the proposal, but instead noted that the proposed disclosures could or may be of value to investors. However, many economic reasons suggest the disclosures would be burdensome while providing limited benefits. First, existing standards already require disclosure of material risks and financial impacts. Second, the proposed disclosures would not require uniform metrics across companies, which, even if investors read, understood, and compared companies' explanations of how their climate impact figures were derived, inconsistent metrics across companies would make such information of limited value. Third, the meaning of materiality would be diluted by the proposal's requirement to make disclosures without netting positive and negative impacts against each other. Finally, share repurchase disclosure, which was subject of yesterday's court ruling. In December 2021, the Commission proposed expanding required disclosures of corporate share repurchases because potentially managers might use share repurchases for their own benefit by decreasing share count to manipulate compensation targets or EPS. However, the Commission ignored the empirical research on this issue, which has found no evidence to suggest any systematic problem of share repurchases motivated by managers' self-interest.
Gentlemen's time's expired. If you could submit the rest for the record, I would appreciate it. And sadly, pursuant to my previous announcement, we will now recess until after votes. We'll get back to you, Mr. Quaadman and Ms. Borrus, and as soon as we get back. My apologies to the panel for the delay, but this shouldn't take much time. All right, members, hurry back. Yep. Oh.
Got it under the wire.
Reception, I had left the concluding remarks, so I
The hearing of the Capital Markets Subcommittee will now come back to order. Let us resume with our witness testimony. And Mr. Quaadman, you are now recognized for 5 minutes to give your oral remarks.
Thank you, Chair Wagner, Ranking Members Sherman, and members of the subcommittee. American capitalization of global public capital markets stands at 42%. To put that in context, the European Union is at 10%, China is at 10% as well. And we all know what the benefits of the IPO market are, right? When a business goes from small to large and goes to the IPO market, you see the biggest spike in revenue, job creation, wealth creation on Main Street. And that is why Congress appropriately put in to the SEC tripart mission, capital formation, and competition. The reason why Congress did that was for the continued global leadership that benefits American investors, workers, consumers, and businesses. Since 2001, however, the SEC has had a negative capital formation agenda. The SEC has repealed the proxy advisory firm rule, a rule that was developed over 10 years on a bipartisan basis that would have regulated the proxy advisory firm industry. Leaving this unregulated now allows 2 firms that are foreign-owned to drive corporate governance policy in the United States, and those 2 firms control effectively 37% of the shareholder vote. We have also seen the gutting of shareholder proposal thresholds, which has emboldened gadfly investors and activists. We also have the institution of the universal proxy card, which incentivizes proxy fights, balkanizes boards, and endangers board fiduciary duties. We also have, as the plaintiff in the case of people have mentioned today, we have a rule that disincentivizes stock buybacks. Everyone in this room that has a 401k plan and is in the TSP plan has benefited from buybacks. Why was this important to challenge? Because the SEC was looking to supplant the business judgment of a business. We also have an activist PCAOB that is pushing forward on proposals like the no-CLAR proposal, which would change the auditor from auditing financial statements to becoming a legal umpire and could, if implemented, make things like parking tickets a material issue. We also have Staff Legal Bulletin 14L, which will further inject political discussions into the boardroom. For those who like 14L today, wait until the opposing party takes control. See if you like it then. So we can talk about how this impacts IPOs, but let me give a real-life example. In addition to running the Capital Markets Center at the Chamber, I also head up the policy teams that deal with technology issues as well as intellectual property. Over the last 5 weeks, I've spent 2 weeks in Silicon Valley meeting with businesses to talk about artificial intelligence and quantum computing. In every meeting I've had, capital formation has come up. And it has come up because we're in the old normal. And by that I mean high interest rates, we have VC funds receding, and we have the federal government soaking up dollars that could have gone into the productive economy to fund the deficit. And the conversation goes like this. The only other option we really have is the IPO market. But look at what the SEC is doing. We don't want to deal with proxy advisory firms. We don't want to deal with activist PCAOB issues. We don't want to deal with thresholds that allow gadflies to tell us what to do. And we don't want to have a board that is not going to abide by its fiduciary duties. That's not an option. So for people who are concerned about competition policy, guess what? No IPOs, no competition. So it's a dangerous thing that is going to have impacts throughout the economy. We appreciate the work that the subcommittee has done on things like accredited investors and e-delivery. They've been important. But this subcommittee can also act in other ways that are going to be important. It could pass a mandatory materiality act proposed by Congressman Huizenga that would require the SEC to come out with a disclosure, when they're working on a disclosure, to have a materiality statement. We could have this subcommittee pass the Putting Investors First Act proposed by Mr. Stiles that would regulate proxy advisory firms. Why? Because the SEC has decided not to act. We should have AFFE relief, either through the Garbarino bill or the bill that has been introduced by Mr. Sherman and Mr. Huizenga that would allow BDCs to fund startups and middle market companies. We want to work in partnership with the subcommittee on these issues, and thank you and happy to take any questions you may have.
Thank you, Mr. Quaadman. Ms. Borrus, you are now recognized for 5 minutes to give your oral remarks.
Chair Wagner, Ranking Member Sherman, and members of the subcommittee, good morning. My name is Amy Borrus, and I'm the Executive Director of the Council of Institutional Investors. I'm pleased to appear before you today on behalf of CII. We're a nonpartisan, nonprofit association of more than 130 public, corporate, and labor employee benefit plans with combined assets of more than $5 trillion. Our focus and expertise are on corporate governance and shareholder rights. CII members are long-term share owners responsible for safeguarding assets used to fund those employee benefit plans of millions of workers and retirees throughout the United States. Since CII members invest most or much of the portfolios in U.S. company stocks, issues relating to U.S. corporate governance are very important to our members. 2.5 years into his term as SEC chair, Gary Gensler has pursued a sweeping regulatory revamp from crypto assets to corporate disclosure. From CII's perspective, Chair Gensler's leadership has greatly advanced the SEC's tripartite mission of protecting investors, maintaining fair, orderly, and efficient markets and capital formation. And CII and its many members are especially heartened that a number of the reforms Chair Gensler has spearheaded align with longstanding CII policies that strengthen corporate governance of U.S. public companies. I'll briefly highlight just 2 of those critical reforms and why they benefit our members and long-term investors generally. And the first is universal proxy. In November 2021, the Commission adopted a rule to require the use of a universal proxy card in director election contests. The rule established a more level playing field for those investors, and that's many of them, who vote by proxy rather than in person at the company's annual meeting. It simply requires that when there is a contest for board seats, the names of all candidates must appear on the proxy cards that the company and the nominating shareholder distribute. This allows all shareholders to vote for the combination of director candidates they believe best serves their economic interests. The SEC final rule reflected many of the points that CII raised when we filed a rulemaking petition for universal proxy back in January of 2014. That petition was based on our policies on director elections, which simply state that when there's a contest for board seats, opposing sides should use a proxy card that names all management nominees and all shareholder proponent nominees. CII and many market participants agree that the SEC final rule appropriately provides shareholders voting by proxy, which is how the vast majority of investors actually do vote, the same options available to other shareholders to express their view on who they think is the best candidates to serve on corporate boards. The second recent SEC reform I'd like to highlight deals with insider trading arrangements and related disclosures. Last December, the SEC adopted amendments to Rule 10b-5-1. That rule was originally intended to prevent executives from running afoul of the prohibition on material non-public information as long as they bought or sold company stock on a predetermined time on a set schedule. The SEC adopted this rule in 2000, but within a decade, loopholes emerged in its operation, and there were press reports and empirical research that suggested that some executives were using 10b-5-1 plans to pursue fortuitously timed trades in company stock while they had material non-public information. So in December of 2012, so more than a decade ago, CII submitted a rulemaking petition to the SEC requesting amendments to Rule 10b-5-1 to close loopholes and enhance disclosure of these trading plans. The petition reflected CII policy, which acknowledges that Rule 10b-5-1 plans have a legitimate purpose, but calls for specific safeguards. These plans should be publicly disclosed and adopted when the participating executive is not in possession of material non-public information. Our policy also states that there should be a ban on trades for at least 3 months following the adoption of a trading plan, and that such plans should not be substantively modified thereafter. The SEC final rule adopted many of our recommendations, and CII and many of our members and other market participants believe that the rule benefits investors by better protecting them from misuse of these plans and by enhancing public confidence in corporate management and the fairness of the capital markets. In closing, the CII looks forward to working cooperatively with the SEC, with the Committee on Financial Services and the Capital Markets Subcommittee, and other interested parties to further improve the corporate governance of U.S. public companies. Thank you for inviting me to participate in this hearing. I'd be pleased to answer any questions.
Thank you, Ms. Borrus. We'll now turn to member questions, and I recognize myself for 5 minutes for questioning. Ms. Blass, I am concerned about the SEC's predictive data analytics proposed rule and the negative effects it will have on innovation and retail investors. The scope of the proposal is extremely broad and could be applied to virtually any technology used by broker-dealers and investment advisors. Can you discuss the impact the PDA proposal will have on innovation and retail participation?
Thank you, Chairman Wagner. So I think we can all agree that the use of AI by advisors and broker-dealers is something that we should be looking at. But a few things. Number one, there is no explanation on the part of the Commission as to why the current regulatory environment does not address the conflicts with the use of AI. Two, this proposal is not limited to the use of AI.
Correct.
It covers, frankly, like per our analysis, Excel spreadsheets.
Right.
So when you look at the breadth of that proposal, tools, technology which has been used to deliver better outcomes to investors, like model portfolios, could be at risk. Technology that has been used by advisors and broker-dealers to manage risk, trading, surveillance could be at risk. Or even more importantly, technology is used to educate investors, like self-directed investors, so they can manage their own portfolios and learn how to trade in the markets. Those potentially could go away. And technologies that financial professionals use to monitor financial wellness, are you underinvested in retirement? All of that can also go away.
And quickly, what about its impact on smaller firms, which have actually fewer resources to manage the heavy compliance costs and thus less opportunity to compete against the larger incumbents?
Given the breadth of the coverage of the rule from covered technology to investor interaction, this rule would be extremely hard to comply with. In fact, in the actual rule proposal, the Commission does acknowledge that it could be impractical or impossible to at times comply with this. This is wording in its own in the Commission's proposal.
Thank you, Mr. Bentsen. The SEC's proposal on open-end fund liquidity would make significant changes to the liquidity risk management practices of mutual funds that would narrow the investment strategies available for retail investors and retail and retirement savers. Can you elaborate on the impact limiting investment strategies in mutual funds would have on those retail investors, and would it potentially reduce returns?
Yes, thank you, Madam Chairman. So you're right. So first of all, there are already liquidity risk management rules in place for
Correct.
open-end fund mutual funds, and have been for quite some time. The problem with the proposal now, I mean, there's been a lot of focus on swing pricing, and there are real concerns with that. We can talk about that. But on the liquidity risk management part, as they are proposed, would really make it complicated for a number of traditional types of mutual funds to operate because of the level of cash that you would have to keep in it. And so probably in the most extreme would be corporate loan funds, which are liquid, which do trade, but would be very negatively impacted by this. And that product would be very hard to maintain that as a retail investment product. Same can be said for small cap funds as well. So the Commission, and we've been talking to the Commission, really needs to think about how the current models work, which we think have worked pretty well, even during the period of the 2020 pandemic.
A solution in search of a problem, as usual. Mr. Quaadman, as you know, and you've outlined, the SEC's mission is to protect investors, maintain fair and efficient markets, and promote capital formation. It can't be said often enough. Can you name any initiatives undertaken by the SEC within the last 2 years that specifically promote capital formation?
So the short answer to that is no, and as I also said in my opening statement, it's actually negative in what they've done. And one other thing I would just point out as well, there's a study that came out from Professor Hal Scott in Harvard that actually showed what the aggressive rulemaking agenda that the SEC has, at least 80% of the rules either don't have a congressional mandate or aren't authorized by Congress. So one of the things the court also found with buybacks, which we also believe is true with some of the other proposals, is that they could not articulate a reason for moving forward on some of what they are also.
Well, and I will tell you that SEC's neglected the capital formation aspects of their mission very badly, much worse than under any previous chair, and I think you all would agree with me on that. Why is it critical, sir, for the SEC's regulatory agenda to explicitly prioritize measures to facilitate capital formation for small businesses?
So for two reasons. Number one is, as I stated, the IPO process is a very important way for businesses to access the capital they need for innovative technologies or whatever they're doing. And secondly, it allows for investors on Main Street to reap the benefits of it.
Time has expired. If you'd like to elaborate in writing, that would be terrific. I now turn to the ranking member and recognize Mr. Sherman for 5 minutes for questions.
Few comments about Mr. Quaadman's presentation. IPOs are important. That's why we shouldn't shut down the government and shut down the whole IPO process. It's been good to work with you on FASB issues, and someday FASB will repeal FASB number 2, and we will capitalize research. Investor protection is not the is not at odds with capital formation. It's a necessary antecedent for capital formation. It is somewhat unfair that public companies have to make all these disclosures and giant private companies do not. And I look forward to working with colleagues on legislation to require multi-billion-dollar private companies to at least disclose some of their effects on our society. The deficit is critically important. That's why we need an effective IRS. I used to, for 5 years, I headed the second largest tax agency, and you get the estimates for the CBO, I think, are way too low in terms of the amount of revenue that ultimately comes in by expanding the auditing of multinational corporations and wealthy individuals. Mr. Quaadman, thank you for your comments on BDCs. I did want to just mention something on Scope 3 for environmental disclosures. It makes sense for and I've said this before, it makes sense for Bank of America to tell us their carbon footprint. But if they have to gather information about every pizzeria they make a loan to, and don't say pizzeria isn't material to Bank of America, because all their small business loans together are hundreds of billions of dollars. If they have to gather information about whether the pizzeria delivers or doesn't deliver the pizza, first, it's absurd, but second, it discriminates against the pizzerias who deliver the pizza and therefore have a bigger carbon footprint. But when all of us from Sherman Oaks have to drive individually to Encino to get the really good pizza, that's more carbon because we're all in our separate cars, but that doesn't count for Scope 3, that's Scope 4, because we're the customers of the customer of the Bank of America. Safeguarding, we've seen with FTX what happens when you trust your asset to a broker and the broker needs to buy a home in the Bahamas. We need to make sure assets are safeguarded. On the other hand, the SEC is working on a safeguarding rule that seems pretty well designed for intangible assets like crypto, but I would think they would write a separate rule for tangible assets such as real estate. Mr. Bentsen, is the rule they're working on over there well designed for tangible assets, particularly real estate?
Thank you, Mr. Sherman. No, it's not. The rule is overly broad and undefined and captures a number of traditional assets and really upends the existing custodian relationship, and frankly is inconsistent with how prudential regulators govern custodians as well. So the Commission really needs to go back to the drawing board on that rule. If their intent is to focus on non-traditional assets, as you point out, of crypto, or if it's to focus on registered investment advisors in the more retail space, they far overshoot the mark in what they've done with the rule.
They may have also overshot with regard to the conflict of interest proposal. Obviously, if you design an asset, you shouldn't bet against it, but nobody designed pork belly futures or oil futures. What are the risks that the proposed rule, Mr. Bentsen, would impede the traditional kinds of investments that people make, where they go long or short in, say, the oil market?
Well, it definitely impacts things like prime brokerage in the institutional market, and which is a big function in the institutional market, and it could cause firms to pull back on the services. And the other problem that it has is it's going to it's going to force firms to for more or less police their clients, which is really the role of the SEC. So getting clients to comply with this would be very difficult. They may not want to do business with the firm. So it has a lot of knock-on effects to it.
And finally, Mr. Quaadman, getting capital to Main Street, small business is critically important. BDCs, business development companies, play an important role. The SEC has apparently decided not to address how these AFFEs have impacted business development companies and their investors. What should the SEC be doing?
We believe the SEC should either exempt the AFFE disclosure or allow for tabular footnote disclosure, as you have suggested as well, because that is double counting expenses, which prevents BDCs from going into indices and shuts off their ability to provide that needed capital for Main Street.
Thank you.
Gentleman's time's expired. The chair now recognizes the gentleman from Oklahoma, Mr. Lucas, for 5 minutes.
Thank you, Chairwoman, for holding this hearing, and thank you to the witnesses for testifying. I think we all agree the United States has the strongest capital markets in the world and have been essential for U.S. businesses and investors during the last, shall we say, several turbulent years. During times of significant economic and geopolitical uncertainty, it's imperative that our capital markets are healthy and well-functioning. That's why it is concerning that U.S. banks must navigate the extensive and disruptive rulemakings from the SEC while also absorbing increased capital requirements under the Basel proposal from the banking regulators. Mr. Bentsen, could you speak to how this level of uncertainty impacts the resilience of U.S. capital markets, and for that matter, how the industry is embracing what appears to be ahead of them?
So thank you, Mr. Lucas, for the question. And while not necessarily the purpose of this particular hearing, you raise a very important point about the Basel III Endgame capital proposal. This is something that's been in the works really for a decade, and the U.S. prudential regulators have put out a proposal that gold plates compared to what the Europeans are doing and what we think the UK will do in this proposal. And in particular, where we are concerned at SIFMA is that it raises the capital on the trading book by as much as 70%. And when you add that to what the U.S. has uniquely, the stress testing regime and something known as a global market shock, it's really a double counting effect. And when you consider that the dealer banks that will be subject to this proposal comprise the vast majority of the underwriting and trading market for traditional assets, whether it's corporate debt, treasuries, munis, equities, securitizations, it's really going to create a squeeze on market capacity. And as I pointed out in my testimony, we finance 75% of U.S. commercial activity through our markets, different than any other jurisdiction in the world. And so that capacity, and we represent the broad market, right? So we don't just represent the large dealer banks. We represent smaller broker-dealers as well, and everybody in between. That capacity doesn't necessarily exist. So if you take that capacity out of the market, you're going to have a knock-on effect into not just investor returns, but the ability of corporates, munis, and others to raise credit and capital.
Absolutely. We've heard from the witnesses today about the unprecedented pace and scope of the SEC's rulemaking agenda, and I'm confident there's still much more to be said on that topic. I want to focus on why the SEC is undertaking such a massive rulemaking agenda. Ms. Blass, most of the proposed rules have no legislative mandate. What deficiencies is the Commission responding to with this volume of rulemaking? Where's this coming from?
That would actually be a fantastic thing for the stakeholders to know so that we could actually help the SEC in the comment process. But when you look at the rules, they do not clearly articulate the necessity for why the breadth, the scope, the pace is not articulated by the Commission.
Mr. Quaadman, could you elaborate on the negative impact on capital markets when the financial regulators undertake such massive shifts in policy?
Yeah, I mean, it prevents, as I was mentioning, it prevents businesses from wanting to access the IPO market and having to look for other places to raise capital. The other thing that it does as well is it also endangers the ability of the United States to be the endpoint of global capital as well. So we're not going to have as much coming into our system also. But this plays out in terms of negatively impacting the competitiveness of the American economy in a global economy.
Fascinating net result. Mr. Bentsen, could you touch on this for just a little bit? The question about the negative impact on capital markets when financial regulators undertake such massive shifts in policy?
Sorry. There are a few things that you have to consider. I mean, if you, all of these different rules are going to impact the market in different ways. As I pointed out, the open-end fund liquidity rule and liquidity risk management could impact the ability to, for investors to invest in corporate loans that then could impact the people who are the borrowers in that corporate loan markets. Radically changing our equity market structure could raise costs for retail investors who have the lowest costs they've had in history, and that could impact their returns as well. If you squeeze the private fund market, which has been a growing market in the U.S., as Tom mentioned, you do cut off the ability for firms to raise capital to invest in plant and equipment and grow the economy. So this really goes back to why you really need to look at all these rules together and not just what the mandate is, but also how are they going to play off one another.
Thank you, Madam Chair. Yield back.
Gentlemen, time's expired. The chair now recognizes the gentleman from North Carolina, Mr. Nickel, for 5 minutes.
Thank you, Chairwoman Wagner and Ranking Member Sherman. 2 days ago, Congressman Stile from the great state of Wisconsin and I led a group of 25 members in sending a letter to SEC Chair Gary Gensler expressing our concerns with the proposed rule on conflicts of interest in securitization. Without objection, I'd like to enter this letter into the record. While we support the goal of preventing bad actors from taking advantage of conflicts of interest in securitization as required under Section 621 of the Dodd-Frank Act, this proposal goes far beyond the congressional mandate by outlawing many ordinary course activities that have nothing to do with securitization transactions. I'm concerned that this will impair the ability of securitization markets, which fund residential mortgages and auto loans. This would increase the cost and reduce the availability of consumer, mortgage, and business credit for my constituents when they're already struggling to make ends meet. Mr. Bentsen, thanks for being here. Can you tell us what harm this proposal, as written, will cause the markets, and why is it important for this proposal to be more narrowly tailored?
Thank you, Congressman, for that question, and I thank you and the Congressman from Wisconsin for weighing in on this issue. It's entirely the role of this committee and Congress to opine on congressional intent, where this is a rule that was part of the Dodd-Frank Act, Section 621 of the Dodd-Frank Act. It's been a pending rule for over a decade. The rule proposed is overly broad, and the concern is, first of all, the securitization market is hugely important, as you pointed out, not just to the mortgage market, but it's also important to, credit card lending, auto loan lending, equipment financing. It has both commercial and retail implication, and it again helps expand the economy as a function. The rule is written goes well beyond the intent of Congress in seeking to address conflicts, as you mentioned, and there are sufficient anti-fraud rules on the books to deal with that. And the problem is that it will be impossible for firms to comply with. They'll have to curtail their activity because of worrying about tripping over the conflict aspect in the rule. So the Commission really needs to go back and narrowly tailor this down. And so Congress weighing in is very important because the securitization market is an important financing tool to the general economy.
Thanks so much, Mr. Bentsen. I'd like to move on to the SEC's Staff Accounting Bulletin 121, SAB 121. I've expressed concerns over how this will actually make digital assets less safe. On Tuesday, the Government Accountability Office found that the SEC was wrong not to send SAB 121 to Congress for review, as it should with an official rule. I'm happy that Congress will now get a say on this rule. The GAO decision is just the latest in a series of losses for the SEC, demonstrating the agency's disregard for the statutorily required processes in the Administrative Procedure Act. Mr. Bentsen, the SEC claims that the goal of SAB 121 is investor protection, but can you explain how preventing the most highly regulated banks from providing custody for digital assets is actually against the best interests of investors, and wouldn't their services make the digital assets ecosystem even safer?
So, yes, we believe so. So SAB 121 is a situation where the SEC was in conflict with the rules, the prudential rules that banks are subject to, and is an example of where there was not sufficient coordination between agencies. And it would have the effect of basically precluding publicly listed commercial banks from being able to provide custody, who are the primary custodians in the world, from being able to provide custody to these assets. So in effect, it would have the counterintuitive effect of driving these outside of the regulated sector of it. So we think that was the appropriate decision by the GAO.
Thanks so much. Moving on to the e-delivery, as the Democratic lead on the Improving Disclosure for Investors Act, which passed out of this committee with bipartisan support, it would make it easier for broker-dealers to deliver documents electronically. Some claim that seniors are against this policy change because they prefer paper and aren't comfortable with digital tools. What's the data show on this claim?
So more and more clients are certainly moving to e-delivery, and we've surveyed investors and found that 3/4 of investors would like to have all or some of their documentation delivered electronically, and there's been no variation in the demographics among age, right? So it's really a thing that's moving in the direction. When we go to T+1, which we will do the day after Labor Day next year, we're going to have to go to e-delivery on certain things because the mail system can't move fast enough to keep up with that.
Gentleman's time.
But more importantly, more investors are finding they view this as more secure, and knowing as well, they can always go back and ask for paper, but they view it more efficient and more secure. So we appreciate the work that you and the committee are doing on that.
Thank you,
Gentleman's
and
time
I
has
yield
expired.
back and thank Mr. Caston for letting me skip ahead of him.
The chair now recognizes the gentleman from Michigan, Mr. Huizinga, who is also the chair of the Subcommittee on Oversight and Investigation, for 5 minutes.
Thank you, Madam Chair, and good to see all of our witnesses. I appreciate it and appreciate your time. I'm going to move kind of quickly here. I do want to touch on something that Mr. Sherman had brought up with Mr. Quaadman, and I appreciate you bringing this up in your testimony about our bill to attempt to fix the problem. Mr. Garbarino also has an approach on that as well, kind of trying to solve the problem in a bit of a different way. And ultimately, we want something moving in this space. I am curious if you could take just a moment to unpack, and I know this is the technical side of this, but the footnote versus the full exemption. Is there a preferred method in your mind as to how we should move forward?
Look, I think in a full exemption is a cleaner way to get there. But I mean, recognizing that we want to have a pathway for success, having a AFFE being in a footnote disclosure, I think avoids the double counting issue, which is really at the heart of why they're not included in the indices, and then prevents them from providing the capital formation tools that they can.
Okay, I'm gonna move on to Ms. Blass, but Tom, did I hear you say that there was a study that showed 80% of all of the rulemaking coming out of the SEC has no congressional mandate?
Either no congressional mandate or is not authorized, and that comes from Professor Scott's Capital Markets Center up in Harvard.
Okay, well, that flows nicely into Ms. Blass, who, for full disclosure, we have crossed policy swords a few times in my office privately when I happen to be the chair and the ranking member of this very committee. And I grew to appreciate you over those years of doing that, because in your 14 years of dedication to the SEC and by extension our country and our markets and our system, our economic system, I figured out that you were there for the right reasons. And I appreciate that. Just wanted to say that. But I also wanted to put out there, we didn't always agree. And it seems to me that the SEC is frankly delegitimizing itself with these types of things. When 80% of their actions aren't actually authorized, aren't actually sanctioned, are beyond their scope. And I'm curious, I mean, in your opinion, is the SEC actually doing damage to its ability to do its important work? I mean, Mr. Nichols just brought this up. Frank Lucas just brought this up. I know others are going to bring this up as well. There's a lot of concern, it should be, on both sides of the aisle. And I'm curious if you could just comment from your 14 years of having worked there.
I think I would raise 2 points. The first being, with this onslaught of rules, and if they all, I mean, Chair Gensler is slated to finalize 61 rules by the end of his term. If with this onslaught of rules, resources are not finite in terms of actual dollars and cents, but also human capital to put this in place. So the first point is we could risk getting to a jurisdiction, and these jurisdictions do exist, where there's no compliance with the rules because it's impossible to comply. Worse, and the second point, is that we could get to a place where there is a regulator-created systemic risk because we break something in the market. We are a very complex, mature market, and if you move too many pieces at once, which is what we are doing here, something is going to break.
Agreed. I've got a minute and a half here. Dr. Kothari, you co-signed a letter with Craig Lewis, chair of Mary Shapiro's regime. He was the former chief economist. That letter was respect to the climate rule, and you noted that the commission made no, quote, attempt to understand the effects of the changes across the economy, close quote, and that the proposal, quote, fails to quantify these costs or even discuss what the impact might be, particularly on small businesses and their employees with whom registrant ceases to do business, close quote. One, do you stand by that analysis with Mr. Lewis? And ultimately in this, how do we manage our way through this issue?
I do stand by the analysis, and more work I'm doing, and that points to the same direction, that it seems that regulation is in search of a problem rather than attempting to address an existing problem. This is nothing to say about whether or not climate risk is real, but as far as SEC and corporations go, do investors face that risk? And the answer is, at least so far, there isn't any evidence of that. And we want that to be a targeted approach rather than a blanket approach of each and every firm having to disclose or having to report about climate risk, whether it exists or not.
Gentleman's time's expired. And the chair now recognizes the gentleman from Illinois, Mr. Caston, for 5 minutes.
Thank you, Madam Chair. Thanks to all our witnesses today. In 2020, the CFTC, under Trump, issued a report managing climate risk in the financial sector that said, among other things, that climate change poses a major risk to the stability of the U.S. financial system. In 2021, the Financial Stability Oversight Council essentially said the same thing, said that climate change is an emerging threat to U.S. financial stability. Last year, there were $165 billion in insured losses from weather-related disaster in the United States, not total losses, insured losses. And of course, we're now seeing multiple property insurers pulling out of markets in California and Florida along the Gulf Coast and moving that risk onto other parts of the system. I'm hoping we all agree, but is there anybody on the panel right now who disagrees that climate change is creating risks to our financial system? Okay, good. I asked that question because I've been in this gig for 5 years. I was 20 years in the private sector beforehand. I don't say that to brag, it's just that I view things from that lens. And if I was running a company that had risks that I was exposed to that markets didn't know about, I would not be standing up and saying, hey, look at my company, I'm sitting on a lot of risk here. I try to offload it, right? And in fact, we're seeing that the sophisticated players are moving risks onto unsophisticated players, whether that's property owners in coastal areas who are selling that risk down to Fannie and Freddie, coal industry that's losing market share to cleaner, cheaper alternatives and is shifting their risks onto pension holders. And that creates risks for the broader economy. Ms. Borrus, do you believe that investors need reliable information about companies' climate risks so that they can allocate their portfolio?
Sorry, thank you. Thank you for the question. And that is very much what we're hearing from many of our members who are long-term institutional investors. You know, CII generally supports the SEC's proposed rule on climate-related disclosures. Many CII members and other investors believe climate change is a systemic risk that long-term institutional investors must address as part of their fiduciary duty.
And I'd argue that whether you believe that or not, like, investors should be free to make their own decisions.
Of course, and we agree with Chair Gensler that the SEC has a role to play in making sure there's some standardization to these to the conversation happening between investors and companies on climate. Investors need comparable, consistent decision, useful information on which to make investment decisions and proxy voting decisions.
So I don't want to cut you off, but I want to just get to a couple of things. But I'm glad you said that. You answered my second question. I often say that the loneliest position in Congress is to advocate for competitive markets, because nobody comes to Congress and says, you know what my market needs is more transparency, lower barriers to entry for my competitors. That's not a thing. But I would presume you would agree that if you have transparent information, markets are more efficient?
Yes.
Okay. Does anybody disagree with that proposition? Okay. Mr. Quaadman, I want to move to you because in your testimony you mentioned the European Union's corporate sustainability reporting directive and some of the challenges, and I think there's a rich conversation we could have about that. I would hope you would agree, wouldn't you, given how many U.S. companies are affected by European regulation, multinationals, would you like the U.S. to have a seat at that table?
Yeah, and in fact, we've been meeting quite frequently with the EU on these very issues, and one of the reasons why we had Chairman Gensler at the SEC, from the SEC at the Chamber last week, was to discuss some of this. That being said, we do think that the extraterritorial impact of the EU rules, particularly with the double materiality concept, puts American companies at a competitive disadvantage.
Well, so I think that there's parts of that I agree with, there's parts of that I disagree with. The concern that I have, that I would just ask all of you to consider and all my colleagues to consider, is that lots of U.S. companies are regulated in other markets. Lots of U.S. companies are regulated in California. And we cannot say that we do not want the United States to have a leadership role by actually passing regulations and then complain about the fact that other people led. We are sailing down a path whereby, if we stop the SEC from acting, we're basically deferring leadership to other countries. And I guess I'd just close. I had more questions, but I'm out of time here. After the United States pulled out of the Paris Climate Accord, I was one of 12 people representing the United States government at the COP in Madrid. We were the only country that was not there. And I got pulled aside by some of my European colleagues who said, can you please go back and tell folks back home that really bad things happen in the world when the United States chooses not to lead? Yield back.
Gentleman yields back, and the chair now recognizes the gentleman from Arkansas, Mr. Hill, who is also the chair of the Subcommittee on Digital Assets, for 5 minutes.
I thank Chair Wagner, thank you, and Chairman McHenry for your dedication to liquid capital markets that are orderly, and investor protection and capital formation, and for bringing this panel to us to talk about the impact of the SEC's regulatory agenda on those goals. And from looking and listening today, I think the SEC under Chairman Gensler has lost credibility with a lot of market participants, issuers, investors, because of what Ms. Blass talked about, 61 rules dumped out on the market, ivory tower ideas without any analytic or statutory framework to support them. He's lost respect here on Capitol Hill on both sides of the aisle due to his flagrant just ignoring the statutory obligation of cost-benefit analysis that actually stands up to a cost-benefit analysis, and his flagrant shortening of comment periods, which time and time again, the members of this committee on both sides of the aisle have had to write and extend. And finally, having lost in the court of public opinion, now the chairman is losing in where it really hits his resume. He's losing in the federal court's opinion. Being accused of the commission of being arbitrary and capricious is not something I would want on my resume were I a staff lawyer at the SEC. And so I'd like to enter in the record today's Wall Street Journal editorial, Gary Gensler loses again. Thank you. Mr. Bentsen, I visited with Chair Gensler about the consolidated audit trail. I know that large Wall Street firms have been somewhat supportive of that, many of the others less so. But he alleged to me in his testimony that the SEC's and the market exchanges' ability to surveil the market for SROs and the SEC is inadequate. Do you think their ability to surveil the market is inadequate?
No, I don't. No, sir. And there are a lot of issues with the consolidated audit trail and that really need to be resolved. And as I pointed out in my oral testimony, a major concern for us is a 3-year pending data privacy rule where we have the largest database in the world with no protocols for the 25 SROs that oversee it or the thousands of employees who work for them. So this is something I know this committee's looked at in the past, and you have and others, and we think shows a lack of prioritization at the commission that what is a really important rule that needs to get done has been sitting for 3 years.
Yeah, well, first, I don't think we need it. We have blue sheets, we have regular ability to do surveillance any day, intermarket, for any number of firms, any way we want to, right now under regulatory supervisory standards and the statute. And so I think that's number one. It's not necessary. Number two, it has a privacy concern on the storing of that data. We're not very good in the federal government of storing people's personal information. We're all victims of breaches here at OPM or the IRS or CFPB, for example. But the third point I want to get your view on too, which is it's unveiled a 2023 budget of $222 million, which is a little higher than when they came to the committee and suggested it would cost $50 million a year. Is there any limit to the spending on this? What if it cost $1 billion to run the CAT?
So Congressman, 2 things. One is we actually advocated for an expedited blue sheet approach as opposed to doing data multiple times with the commission over multiple commissions, and they didn't agree with us on that. Yeah. But you're absolutely right. The broker-dealers have all the obligation and no authority, and now we have all the cost, which will get passed on to the end client under the CAT. And we're not part of the management group of it. We have no line of sight into how the budget's developed. We have no line of sight of what the budget is. And you're right, it's grown exponentially.
Thank you. Let me switch gears, and anything you want to add, I'd encourage you to participate by forwarding it to me for the record. Ms. Blass, I'm concerned that we're trying to take private institutional funds and have them be disclosed as if they're for retail investors. You ran the SEC's investment management division. Is this overkill, and is it unnecessary? The private fund advisors rule that Mr. Gensler has proposed.
Sir, it rewrites a $26 trillion industry between advisors and the most sophisticated participants in our markets. It does not explain why it's necessary or appropriate. The costs will be extreme, and it's going to have a large impact in particular on the smaller advisors and create a tremendous barrier to entry. And a lot of these smaller advisors are women and minorities. And private funds support small business. So all of this will be impacted by a rule that the SEC really has not explained why it's necessary or appropriate.
I thank you, and I'll yield back to the chair, and I thank the gentlewoman.
Gentleman yields back, and the chair now recognizes the gentleman from Missouri, Mr. Cleaver, for 5 minutes.
Thank you, Madam Chair. Thank all of the witnesses for giving of your time today. Ms. Borrus, as you note in your testimony and on your organization's website, the Council of, and I quote, the Council of Institutional Investors members include U.S.-based asset owners or issuers and include more than 130 public pension funds, corporate and labor funds, and foundations and endowments with more than $5 trillion in combined asset under management. As you may expect, I'd like to raise a diversity issue. The assets begin with investors, including institutional investors, and flow through professional asset managers before taking root in companies and projects, providing asset managers a critical role in influencing how capital is distributed throughout our economy. Despite this critical role, women and minority-owned asset management firms currently control 1.4% of the over $82 trillion with a T in management assets in the United States compared to the 98.6 of assets controlled by firms owned by white men. And so studies have shown that the performance of diverse-owned firms is not statistically, this is critically important this from my perspective, it is not statistically different, and in some cases, even better than the broader industry. The lack of utilization of women and minority asset managers by individuals, organizations, and institutions, including some of our largest universities, some of our elite universities, is not explained based on performance or availability. Senator Booker and I introduced a bill, the Endowment Transparency Act, to require reporting from colleges and universities about how they are working with women and minority-owned firms. And my office is also connected with several of your members about the business case for adopting policies to monitor and strengthen relationships with women and minority-owned firms and companies, and how this issue is material. So can you tell me how your members think about this proposal and whether the council has work streams on this issue?
Thank you for the question. Many of our public fund members and our asset manager members do have emerging manager programs to extend and deepen their use of minority-owned firms. CII does not have particular policies on asset manager programs or diverse-owned investment programs, but we do support and have supported for a very long time disclosures about board diversity and the diversity of executive officers. For example, we have a long policy on board diversity that we think it should reflect the view that corporate governance best practices support diversity that reflects the communities, the employees, and the customers of corporations, and that would include investment firms as well. And we have also supported the NASDAQ listing standard calling for disclosure of board diversity.
Thank you. I appreciate that. The issue is, major universities, for example, they are proud and ought to be when they have a diverse faculty. And they can go out and recruit students and saying to them, we have a diverse faculty and a diverse student body, and corporations, some corporations will do that as well. But we're never going to be able to have the level of equality in this country, in this industry, until we're able to participate in the economics. And when you have 1.4%, that's just, do all of you agree that that's insufficient and that we need to take some steps?
Yes.
Proceed, go ahead, please.
I think there's a lot of, it's a supply issue. I mean, if there is any active discrimination, of course we should stamp it out. But otherwise, and we should also educate and encourage different people to participate. But in the end, if we find there are fewer, I don't know if we necessarily have to step in and have an identity-based or
Gentleman's
gender-based
time's expired.
dictated policy.
I'd like to talk to you about that
Gentleman,
further.
time's
Thank you,
expired.
Madam Chair. Thank you.
The chair now recognizes the gentleman from Wisconsin, Mr. Steil, for 5 minutes.
Thank you, Chair Wagner. Mr. Quaadman, thanks for being here. Thank you all for being here. As you know, I'm very concerned about the proxy advisor duopoly, so probably no surprise I'm going to have a little bit of a conversation here about that. As we look back at Chairman Gensler removing the 2020 proxy advisor reforms, blocking enforcement of these rules in order to rewrite before the reforms had even gone into effect. And so just to scale this, can you think of another example where the SEC decided to undo its own rulemaking before it had even gone into effect?
The other example I would actually raise, it's not finalized yet, but the Gensler SEC is also pulling back on the shareholder proposal threshold rule. They have not finalized that yet. But what I would say is, and I mentioned this in my opening statement on the proxy advisory firm rule, that was based on a 10-year effort that spanned different administrations, was bipartisan, had roundtables, concept releases, comment periods, that there was empirical evidence that went into that.
Completely right. A full review, they go in and they nix it. That's really an unprecedented move by the SEC as we think about the broad rules, the rulemaking process over decades that the SEC is engaged in.
Yes.
Have you seen that type of action previously to Chairman Gensler?
No, and that's why I do think your bill is so important, that if the SEC is not going to act in order to prevent our corporate governance from being mandated by two foreign-owned firms, the Congress is going to have to.
So the SEC acting in this manner, does that impact the SEC's credibility, in your opinion?
Yeah, I mean, what it does is it degrades their ability to allow for an important part of the marketplace to be unregulated. It also it impacts their rulemaking capacity as well as enforcement capacities as well.
So let me slightly shift gears here, and as we look at the SEC trying to drive forward more ESG-related shareholder proposals, and in particular, I've been concerned about Staff Bulletin 14L. I've had this conversation with multiple individuals working at the SEC. In kind of the widespread definition, quote, widespread public debate with a, quote, broad societal impact. And so, not surprisingly, following 14L coming out, we saw one of the highest number of shareholder proposals ever submitted, most focused on non-material ESG issues. Are widespread public debate and broad societal impact clearly defined terms in securities law?
They are not. And in fact, we sent a letter to the SEC in November of 2021 where we highlighted where those issues, those controversial political issues that the SEC is now going to have to weigh in. And what it will also do is it's going to create a pendulum swing between administrations as to what those issues are. And I would actually say the no action process before 14L came in both Democratic and Republican administrations, was a colorblind process. And in fact, when no action relief was given, there are studies that show that the stock price actually went up, which means the system was working.
And when you say colorblind, you mean for political purposes?
Correct.
And so now you're seeing that the SEC is operating under a political lens because they have an opportunity because of the broad language of 14L?
Yes. The board and the shareholder proposal process is about the strategic direction of a company. It's about a fiduciary steward of the assets of the company. It is not about creating a political debating society in the boardroom, yet that's exactly what 14L is going to do.
Thank you. Final minute. Let me jump gears to you if I can, Mr. Bentsen. In particular, as it relates to the conflict of interest in securitization, I just want to dive in kind of quickly here. Can you describe what happened to some of the largest financial institutions scaled back securitization activities or stepped away from the securitization business lines altogether? What would be the real-world impact if this has the draconian impact that I believe it will have?
So thank you for that question, and you're right. The rule is broad, and it would affect the ability of firms to do hedging, to act, to fund that market. That market funds floor plan lending, it funds equipment financing for small and medium-sized businesses.
And so what would be the 100%? What would be the impact on housing or on consumer credit?
Again, the more you pull back credit, you're going to affect price. And
In effect, price is going to make loans more expensive for everyday Americans. Is that right?
Conceivably, yes.
And it's so broad. Would it force participants out of the market? Do you think that's one of the intended goals of the Securities and Exchange Commission?
I think it's, I can't speak to what the intended goal is other than the rule is overly broad.
But it will increase cost.
Congress intended.
It will increase cost to lenders. That's my concern.
I think
Cognizant of the time, I yield back.
Gentleman yields back. The chair now recognizes the gentlewoman from California, the ranking member of the full committee, Ms. Waters, for 5 minutes.
Thank you, Madam Chair. Mr. Borrus, you represent the Council of Institutional Investors, whose members are pension funds managing trillions on behalf of working families and retirees. The Council, among other pro-investor issues, is focused on federal and state policies that protect the right of shareholders to offer proposals on company ballots and to receive independent proxy advice. Ensure investors receive the best execution of their orders on any order-by-order basis, and encourage disclosures around climate change, diversity, and key workforce metrics. Can you set the record straight? Has the SEC under Chair Gensler done a good job living up to those priorities that working families and retirees care about? Specifically, I'm wondering if any particular rulemakings come to mind that positively address the issues of proxy voting, market structure, and climate disclosures.
Thank you, Ranking Member Waters, for the question. I'm very pleased to answer. In the affirmative, as you indicated, CII member funds include major long-term share owners with a duty to protect the retirement assets of millions of workers and their families throughout the United States, including pension funds with more than 15 million participants. These are the true Main Street investors through their pension funds. And we believe these workers and their families have benefited from the pro-investor rulemaking that has characterized Chair Gensler's SEC. With respect to the 3 rulemakings that you referenced, Chair Gensler's 2022 rule on proxy voting advice, we think appropriately rolled back certain provisions of the 2020 rules that most investors and many other market participants believe were unwarranted, would have unnecessarily increased the cost of proxy research, and that additional cost would have reduced the benefits available to retirement funds of many workers and families. With respect to market structure, we generally support the SEC's proposed rule on regulation best execution. Consistent with CII policies, we agree with Chair Gensler that a best execution standard at the commission level rather than at the FINRA level could lead to a better execution and lower costs for institutional investors and the workers and families that are beneficiaries of those funds. Finally, with respect to climate disclosures, many CII members and many other market participants believe that climate change is a critical systemic risk that long-term institutional investors must address as part of their fiduciary duty to the beneficiaries of those funds. Investors need consistent, comparable, and decision-useful information about climate risks and opportunities to inform their investment and proxy voting decisions. We would note that the market structure proposals and climate disclosure proposals are just that, they're proposals. CII and other market participants have written letters, comment letters to the SEC describing how those proposals could be improved. And we are confident that the SEC under Chair Gensler will carefully consider those comment letters and make appropriate improvements to the proposals before issuing final rules.
Thank you. As the witness has stated, Chair Gensler has indeed done a great job protecting investors through rulemakings on proxy voting and market structure, and even climate change with the disclosures. I have a few more seconds here. The SEC previously approved a rule regarding corporate board diversity for all companies listed on the NASDAQ Stock Exchange. This rule requires companies listed on the exchange to disclose the diversity of the board of the company and those that do not have at least 2 diverse board members to explain the company's reasons for not meeting this diversity objective. This rule was upheld by the Fifth Circuit Court of Appeals just past week. As a longtime champion of diversity in the financial services space and corporate world more broadly, I welcome the Fifth Circuit's affirmation of the NASDAQ diversity rule. Do you agree that this NASDAQ rule is a good thing?
Yes, I do. CII has supported the NASDAQ rule, board diversity listing standard, including participating in the filing of an amicus brief on the Fifth Circuit, defending the actions of the NASDAQ and the SEC. Like the Fifth Circuit decision in favor of the standard, we concluded that the standard, it's a standard. It doesn't establish a quota. Rather, it's a disclosure requirement that provides standardized information on board diversity. And as I said before, many investors consider this information as an important factor when voting on nominees for corporate board seats or casting or making investment decisions.
Thank you. I yield back.
Ranking member yields back. The chair now recognizes the gentleman from Pennsylvania, Mr. Muser, for 5 minutes.
Thank you very much, Madam Chairwoman. Thank you all very much for being here. We know you're quite busy. Clearly, there's a lot of new complex regulatory proposals coming down the path. Over 60, I understand, from safeguarding, climate rules, predictive data analytics rule, volume-based pricing rule. As stated very often by everyone, the comment periods are too short, making it hard for the industry as a whole to keep up. So you know, such rapid rule changes I was in business for over 20 years myself. I mean, the level of unpredictability and day-to-day operations, certainly long-term strategic planning, and obviously a more balanced approach, a more thoughtful approach, a more inclusionary approach, you know, talking with industry stakeholders and even the commissioners along the way in order to carry out the mission, right? To protect investors, maintain fair and orderly and efficient markets, and facilitate capital formation. And I just, no matter how I look at it, and in conversations with Chairman Gensler, I just don't know, and I think he's dedicated and hardworking, certainly, and smart, but what is the goal here? I mean, if that's the mission, why isn't it being accomplished? Why is it that virtually 80%, 90% of the stakeholders I talk to, and 4 out of 5 of you here, I think have some real constructive criticism of what's being done on a daily basis? I mean, let's just talk for a minute about the volume pricing issue, Mr. Bentsen. I'll cast this one to you. Is it a good plan? It doesn't seem like it's going to really benefit who it's intended to, you know, it's portrayed that it's actually going to benefit.
Thank you, Congressman, for that question. Yes, this is the latest, the 5th SEC equity market structure proposal, and it would affect the the rebate and access fees that exchanges charge to dealers who utilize the exchange. It's not clear to us that it will serve the purpose. The SEC seems to feel that small broker-dealers are somehow disadvantaged by it. We don't see the evidence of it. And I think it's actually more indicative of, to your point, of Ms. Borrus, you know, I agree, you know, these are proposals that are put out there, just proposals. But proposals are like live ammunition. They are not like concept releases where you're putting out an idea. They're not like a round table. And as I said in my comments, when the SEC developed the bedrock foundation of our equity market structure today in 2005, it did so after this committee, and I served on this committee during part of that time, had multiple hearings on this. There were round tables. There were multiple concept releases put out. And then we ended up with Reg NMS. Reg NMS is old, but it still works, and it does need changes. All of us have said that. But to put out very serious proposals, which could become final rules, we have to look at that like that can be there. So this is a case where you really need to think about what the impact is. And even the SEC's own cost-benefit analysis on the equity market structure rules said they cannot, with any certainty, determine what the cost or benefit will be because they don't know how market participants will react to the rules. That's a quote from their cost-benefit analysis. They're really going too fast in this particular item, but we have to treat it as if this is going to become a rule in some form or fashion.
I agree, and your analogy to live ammo, absolutely. It could go off, so therefore we need to prepare in the appropriate long-term manner for first survival and then good business. I really appreciate your responses there. Mr. Quaadman, not to skip over anyone else, but would you as well comment on that? And why is there such a blind eye? Is it because they're not speaking to the stakeholders? Is it because they're not including the other commissioners? Why is it that the Fed has such a blind eye to Basel III, for instance, and how that is being now affecting banks as of today? Meanwhile, as you said, Mr. Bentsen, it's only a proposal.
No, thank you for that thoughtful comment. First, we just released a couple of days ago a corporate treasurer survey that actually outlines how some of these proposals, both from the SEC and from the banking regulators, are actually going to increase financing cost. To get to your other point as well, this SEC is not engaged in roundtables. It is not engaged in soliciting feedback in a thoughtful way, which is why, as an example, we think there are very significant flaws with the cyber disclosure rule, as an example, but even plays out with the cost-benefit analysis. So one is on the climate rule. The SEC's own estimates are that the compliance costs with that will be $6.3 billion, initial costs. All-in disclosure costs today are $3.9 billion. With SOX, the SEC was off by 100-fold on its costs.
Thank you. I'm out of time.
Sorry.
I yield back, Madam.
Gentlemen, time's expired. Didn't mean to drop the gavel. The chair now recognizes the gentleman from New York, Mr. Lawler, for 5 minutes.
Thank you, Madam Chair. Professor Kothari, I noticed a comment letter from Professor Boyd from VCU in the Predictive Data Analytics Proposal comment file that highlighted the woefully inadequate economic analysis done by the SEC on this rulemaking. Professor Boyd previously served as financial analyst and consulting to the Office of the Chief Economist at the Commodity Futures Trading Commission. So like you, she has extensive experience in economic analysis. Her letter points out 3 fatal flaws in the SEC's economic analysis. Number 1, it doesn't meaningfully analyze or quantify the existing benefits for investors that technology provides. Number 2, it underestimates the cost of complying for broker-dealers and investment advisors. And number 3, it fails to attempt to quantify the cost to investors in the likely event that the proposal causes firms to reduce or eliminate technologies that otherwise benefit investors. Can you elaborate on the points that Professor Boyd made? Are you concerned that this rule has completely ignored all of the benefits that technology provides retail investors, like real-time updates on corporate actions, investor education, relevant news articles, et cetera? Professor Kothari.
I'm not entirely familiar with that, but in general, the economic analysis has been deficient in coming up with the cost estimates as well as especially the benefits, because benefits oftentimes are, is there an externality? And they have been quite difficult to estimate, but the current Gensler and Chair Gensler and the DERA have been rather insufficient in their depth of analysis, and that's what I have commented on some of the other disclosure and order competition in those proposals.
Ms. Blass, in your previous role as Director of Investment Management, how did you engage the public and gather input from everyday investors before embarking on significant rulemaking?
Did you employ any non-mandatory activities beyond the Administrative Procedures Act to gain market insights and feedback from stakeholders?
Absolutely, and thank you for this question. We actually did several outreach initiatives, investor outreach initiatives, director outreach initiatives. We engaged in roundtables. So I led the interdivisional team that did the standards of conduct. We conducted roundtables not just in Washington, D.C., in several other cities to make sure that we expanded the scope, concept releases, a request for information, even at the staff level. And frankly, one other tool, when you propose something that does not work, you repropose it. You don't just go to adoption. Lots of tools.
Are you aware of the current Division of Investment Management voluntarily engaging in any activities to gather feedback and enhance market understanding before introducing the swing pricing, hard close, and liquidity risk management rule?
Thank you, Congressman, for this question. I want to start by saying that the division staff is extremely talented. They are incredible professionals that are really dedicated to the career staff, to the agency and its mission. The rulemaking staff is very small. There are about 20-some individuals, and if you look at the number and scope and breadth of rules that they have pushed out, quite frankly, it's kind of hard for them to do exactly what you asked. They're doing their best in trying to push out and meet an agenda that is incredibly aggressive.
So given the fact that they are advancing a lot of different rules, and given your prior experience, do you think what they are currently doing is adequate in terms of the activities that go beyond the Administrative Procedures Act?
The chair of the commission is the person who sets the agenda, and the staff executes. Given what they have been tasked to do in pushing this agenda out, I don't think they've had the time necessary that they usually would have had, definitely that we'd had, to make sure that they solicit the relevant stakeholder input, not just through the comment process, but also from regulators. You've seen that deficiency in the safeguarding proposal. So lots of things that could be done that have not been done.
Thank you. I yield back.
Gentlemen's time's expired. The chair now recognizes the gentleman from Iowa, Mr. Nunn, for 5 minutes.
Thank you very much, Madam Chairwoman, and appreciate this august group coming forward to talk about both the SEC and what its impact is to a small ag state like mine in Iowa that consistently outkicks its coverage both in the financial sector and in the ag area. The SEC Chairman Gensler's watch, he has put forth an unprecedented number of rule proposals that you have all highlighted in an attempt to implement his rulemaking agenda before the 2024 election, meaning the administration, not Congress, is the one leading the charge on this or attempting to. These market-altering proposals have been pushed by the chair's own agenda, contrary to any input from industry and a lack of real economic analysis being done. Further, the chair has proposed a 63-plus sweeping new rule-making regulations that are increasingly interconnected, in conflict, and oftentimes impractical. The SEC has failed to evaluate the aggregated effects of these proposed disclosures on business, on investors, and the overall U.S. economy. In fact, the SEC's own staff highlighted several of these same concerns with the chair's aggressive agenda on a shortened comment period. That ability to really frame what we're trying to do here, and the Inspector General's statement on the SEC's management and performance challenges from last year. But still, the chair has plowed forward with a plan that could be very injurious to Americans. Any oversight questions of his agenda, even when presented by our own chairwoman and a bipartisan members of both Republicans and Democrats, have gone unanswered on things like swing pricing, and lackluster responses are an affront not only to Congress, but to my folks back in Iowa. If Congress can't get an answer, I don't understand how Americans are supposed to get an answer. So I'd like to begin with Mr. Kothari. Your experience as Chief Economist and Director of the Division of Economic Risk Analysis, I think is relevant. When I asked Chairman Gensler about his custody proposal last month, he claimed that he coordinated with the CFTC, that group that does commodity for ag, before proposing his rulemaking. And I highlighted it to Gensler that in the custodial proposal mentioned, he only talks about agriculture one time. One time with the CFTC in a 432-page proposal. In your opinion, sir, do you think that there was any coordination between the SEC chair and that of the CFTC.
Let me begin by saying that I'm a proud Hawkeye too.
Go
I went to
Hawks.
University of Iowa for my PhD, so I have my first exposure to the U.S. was in Iowa, and I'm eternally grateful for that. As far as the coordination with other agencies seems to be on much less these days. I mean, when I was at the SEC, we routinely had meetings with the Fed, with the Treasury, with the Council of Economic Advisors, with the FTC and Department of Justice, and also on regulation best interest. It was with Department of Labor multiple times. So we had a very regular, collaboration and contact with other agencies. And I have experienced that in this case, in that particular proposal, especially with CFTC, with only one mention of agriculture, that seems on the low side. And CFTC is, with the commodities, entrusted, that agency is entrusted with regulations surrounding commodities, and having only one reference on an important matter like that seems on the low side.
And Dr. Kothari, I would agree with you, not only the coordination of the SEC, but the disregard for other agencies, even under the administration, becomes very concerning. It is very disappointing to blow off Congress. It's another thing to bully your way through the rest of the administration. Mr. Bentsen, I would like to ask you a similar question here about the custody proposal. Your firm was one of many that met with Chairman Gensler regarding overly expansive definitions when it relates to custody and assets. Can you explain how the proposal put forth by the SEC chairman could impact, my constituents' ability to hedge on their grain, corn, soybeans, other ag issues?
So thank you for the question, Congressman. And yes, we've met with the chair and with members of the staff, had multiple meetings, and hope to have more because of our concerns about the overbroad nature of the rule proposal. And to your point, it does conflict with how futures commissions merchants deal with custody issues in the futures markets, which of course the ag risk management is the bedrock of our futures industry in the U.S. And so I agree with the doctor that I think the lack of coordination really has resulted in almost inadvertently bumping into these other rules, but that ends up making bad rulemaking and has negative consequences for the end users like the ag community.
I want to thank you very much and thank the chairwoman for leading the charge on this. I yield back my time. Hopefully we can get some answers from the SEC.
I thank you, and the gentleman yields back. I want to really thank our witnesses for their testimony today. This wraps up and culminates our capital formation progress that this committee has made on a bipartisan basis, some 36 bills, many, many hearings on, somewhere between 50 to 60 rapid fire rules and regs that have been put out by the SEC. We appreciate your expertise on both sides of the aisle. Without objection, I would say all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. This hearing is now adjourned.